Okay, everybody, it's me, Gregory Mannarino. Let's see if I can get the date right. It is Wednesday, January 12th, 2022. Got it. People, look, let's talk you and me. A lot of stuff is going on here, but let's start off with the market. Okay, so what happened today? We had slight gains across the board with regard to the major indices, but that's not where the real action is, people. Again, stop fixating on the stock market, looking at the Dow Jones Industrial Average, the S&P 500, the NASDAQ. Okay, these major indices are essentially where everybody does look, but you're looking in the wrong spot. If you are trying to understand the market, you shouldn't be looking at the stock market itself. You need to look at the drivers. Okay, how many times have I said this? What is the driver, the main driver of this market? I'll wait. Exactly, the debt market. The stock market itself, people, I'm going to say this again, and I want you to really let it sink in this time. The stock market itself, the value of the entire stock market derives its value from the debt market. So what does that mean? The stock market is a derivative of the debt market. If you understand that, okay, well, it should be simple so you know where to look. Let's look over at the debt market, more specifically the 10-year yield. I have covered this for now, I don't know, over an entire decade. If you understand that the driver here is debt, global debt, not just the debt market here in the United States, but global debt is the driver for world equity markets. Once you understand that, it makes it simple for you to gauge where you think the stock market's going to go. Now, if you look at the 10-year yield, since we had a nice run-up as the market is pricing in a Fed rate hike, well, we saw the market adjust a little bit. We had a little bit of turmoil in here. We had a sell-off in the NASDAQ, for which I told you was way overblown. And I still believe that the market always overreacts. You and I, we take advantage of market overreactions, either to the upside or to the downside. All right, now that the market is kind of taking it all in, adjusting to this new environment, which we will be getting a rate hike sometime soon. There's no doubt about it, but it's going to be meaningless. That's something else I want to talk about too in just a little bit. But understanding that, again, the stock market itself is a derivative as to the action in the debt market. In other words, the stock market derives value from action in the debt market, and the debt market is stable. There's nothing major going on. Well, one thing pretty big happened today. The US dollar, the Dixie, the relative strength of the dollar literally fell off of a freaking cliff. Now, this is stock market positive. Period. The end. I think you will understand that. All right. Weaker dollar is great for the market. It's terrible for people losing purchasing power, watching the absolute strength of the dollar evaporate right before their eyes. Henceforth, why? You become your own central bank, bet against the debt, hold physical gold, physical silver, cryptocurrencies as well. You stay along the market. Okay. There are no red flags here in the market right now. And I'm talking about the debt market. Again, if there are no red flags here in the debt market, what do you think it means for the stock market, being that it's a derivative of the debt market? Exactly. The market is going higher. The market is going much higher, at least in the short run. Yes, indeed, we are going to run into an epic moment where we're going to get an implosion in the debt market. It's going to implode on an epic scale. And that's going to destroy global equity markets, and a simple wealth transfer effect is going to occur. Cash is going to move from one set of assets into another set of assets. And I believe those assets are going to be commodities. Commodities are going to surge higher than people can possibly imagine in what can absolutely be a hyperinflationary environment. That's what's going to happen here. And that's when cash is going to really start to move, bleeding out of the debt market, bleeding out of the stock market, and just moving into other assets. And I believe some of those assets as well are going to be cryptocurrencies. So that's when the debt market implodes, or the driver of the stock market implodes. Well, the stock market is going to implode with it. You understand? And just cash is going to move. That's all it's going to do. It doesn't go to money heaven. It's going to move. I think you're all well aware of that. Anyway, going back to the markets here. Cryptocurrencies did well today. Gold and silver did well today. I already told you the dollar pretty much fell off of a cliff. Crude oil continues its march higher. WTI near $83 a barrel now, also going much, much higher. I think you all know that. You and I have been buying all the dips along the way, capitalizing on the market's not going to stop, period, the end, because the easy money is not going to stop. Let me touch on something real quick. There's a major deception going on right now. The Federal Reserve wants you and me and people to believe that by raising rates, they're going to somehow slow down the surging pace of inflation. Think about it. Do you believe that's going to happen? If you do, I don't blame you, really, but it's not the truth. You see, it's a grand deception. The Federal Reserve is pushing the narrative, along with all kinds of other freaks from the Fed, the Fed chair, the Fed presidents, that they're going to meaningfully raise rates here because they're ready to fight inflation. It's not going to do a damn thing. First of all, they're not going to meaningfully raise rates moving forward. It's going to be token rate hikes, period, the end, because the Fed's not done inflating. Central banks around the world are not done inflating. In order for it to make any difference, the Fed would have to do very dramatic things. Number one, they would have to stop supporting the stock market, and they're not going to stop doing that. They're going to make sure easy money continues to pour into the market, creating an environment of risk by design. Why do you think, for example, the Federal Reserve has kept rates suppressed since the meltdown of 2008? Why do you think? What's the real secret behind it? Well, to inflate the stock market. When you artificially suppress rates, like the Federal Reserve has been doing, it creates a deliberate environment of risk. And cash flows right into the stock market. And what happens? Record high, record high, record high, record high, record high. And to keep that going, they've had to inflate the monster of all monsters, and that is this debt market hyperbubble. Not going to end anytime soon. And we can see when things are going awry or wrong by looking for red flags in the debt market, which is the driver of the stock market. So when you hear anyone talking about a market crash week after week or month after month, ask them, if you follow their work, what's the debt market look like to them? How is the action in the debt market, other than it being a hyperbubble? I'm admitting it's a hyperbubble, but it's stable. Okay? You can't have a meltdown in the stock market without a meltdown in the debt market. Period. That's just the way it is. But again, you're going to be misdirected and misled by a lot of these people calling for crashes because they want you to watch their dog shit videos. And they've been wrong 100% of the time. So, like I said, the Fed wants people to believe, I'm writing stuff down, that by raising rates, they're going to meaningfully affect the rising and skyrocketing pace of inflation. It ain't going to happen. It would have to be, the Fed would have to raise rates so dramatically. They would have to literally stop buying assets, stop printing cash out of thin air. We would have to change the whole model of the economy from a debt-based system to a wealth-based, and it'll never happen. The debt-based system is how central banks keep their strength. The minute, the nanosecond that we prevent a central bank from issuing $1 single more of debt, they implode. You see, central banks' Achilles heel exists in one thing: their ability to issue debt. If we take that away, if we had a real leader, but we don't, because they are the government now. But if we somehow miraculously created or sent down from I don't know, God himself, a person that would stop the Federal Reserve from issuing a single dollar in debt, that they die. The moment, the nanosecond, they can't issue a dollar more debt, they die. You're not supposed to know that. That's their Achilles heel. Henceforth, why you continue to see debts hyper balloon. The more debt a central bank issues, the stronger they become. It's that simple. I've covered this for 1,000 years now, it seems like to me. The Federal Reserve is not going to stop manipulating this market, people. I want you to realize that until they're ready. And when they're ready to do it, it'll be by a moment of their choosing. But we can still look for clues. We can look for clues in the debt market. So we will know in advance when we're going to get a real cratering of the stock market or a crash. We will, I guess, get corrections. We don't get them anymore. We will suffer from rough patches in the market, which sounds more like a feminine product to me. Whenever I hear people say rough patch in the market, it reminds me of a feminine product. Don't ask me why. Yes, I'm not normal. Anyway, I think we pretty much have a handle on all this. The deception right now, I want you to pay attention to it. The main deception right now is that by the Fed raising rates, it's going to slow inflation. We heard from our president today, the illustrious retard President Biden, who is trying to tell you that the abysmal news that we got this morning on inflation continuing to skyrocket month after month, year after year, it's proving to him that things are looking better. I guess if you're deranged or in some kind of, I don't know, if you're suffering from dementia of one type or the other, yeah, of course you would see that. But again, he's there to lie to you like every president is, okay? Look here, don't look here. And keep in mind that the Fed has no intention whatsoever on doing anything about inflation. They're going to continue to inflate. That's how they keep their stranglehold on the control system. This is all about control, and I think you know that. So anyway, here's another dog shit piece of information here, the Fed's beige book. Apparently, the Fed's beige book on the economy is showing several things. Okay, parts of the economy are doing moderately well, while other parts of the economy are not doing so well. The whole entire economy is cratering. Okay, and as a percentage of GDP, the global economy is cratering as central banks continue to inflate. It's out of control. They're robbing us blind, people. They are literally, they want us all dead, I think, honestly. They are trying to wipe out the middle class and doing a very successful job in that. It's terrible. People, here's another piece of information that I don't think is going to surprise you. So more retailers are saying they have no choice but to raise prices. Restaurants, no choice but to raise prices, especially in light that we now have inflation surging yet again higher and faster than it's ever been. In the United States, we just found out this morning, like I said, 7% inflation right now. The Fed had a 2% target, not being held to account, and they won't because they are, in fact, the real government. Anyway, what else do I got here? So, anyway, that's the story pretty much with what I want to cover here, people. And I know you understand it, but start paying more attention to things a little bit maybe than you already are. Look at the MMRI. The Mannarino market risk indicator has come down. It's still in the yellow. It's showing moderate risk. But again, understand the drivers of the market is not going to stop. And the grand deception that's going on right now with regard to the Fed. Oh yeah, we're going to raise rates and that's going to combat inflation. How about there's no effing way that that's going to do that. And with regard to their runoff, the balance sheet runoff, it's a joke too. They want you to believe they're going to sell assets on their balance sheet to some unsuspecting buyer who is willing to own it. Meanwhile, they can go into the open market and buy a unit of debt. Why you'd want to own it, I don't know. That would yield higher. Makes no sense to me. It's not going to happen. Okay, so realize again what you're looking at. And all of this will become crystal clear to you. All right, people, look, I'm going to end this video here. I think it's been kind of informative. At least I hope so. Please share it. Please get it out there. I want to hear from you as well. Like I always say, please comment here. What do you think about this stuff I covered today in this particular video? Does this make sense to you? Do you believe the narrative that by the Fed raising rates, it's going to really slow down the pace of inflation? No. What you can expect is inflation to get much, much worse moving forward, much worse. But you're not allowed to know that. And again, the distractions, the deception, like the president today, President Retard, explaining that, oh yeah, the reports we got today are showing that his plan is working. His plan? He has no plan. The man, he's brain dead, and he's a puppet on top of all. They're all puppets. This one's a puppet. The last guy was a puppet. The guy before that was a puppet. They're just a spokesperson for people to get down on the hands and knees and do this too. That's all it is. Okay? They're put there They're just put there as a figurehead to keep people distracted, to keep people divided. Okay, that's how they win. Divide and conquer. You all know that. Look, I could keep going on, but I think I covered a lot of stuff here. I want you to absorb it, maybe even watch this video twice. With that said, love you a lot. I will see you in the morning.